Dark clouds are emerging all over the U.S. economy. This fall, many events can make the outlook even grimmer for companies. That's why many retail chains are shuttering multiple locations right now. Some brands are taking an extra step to ensure their financial stability in the near future, so they are eliminating underperforming stores from their system before they impact their long-term profitability. At the same time, many others are in the process of liquidating their inventory and going out of business this fall. Every day, new reports detail the huge wave of store closings that's now taking form. Even though it's too early to measure the scope of this downturn, one thing is absolutely certain. The American retail landscape will look a whole lot different in early 2024. In this video, we investigate which popular brands are reducing their store counts to survive the ongoing recession. Without further ado, here are 15 big box retailers that are closing multiple stores this fall. 1. Christmas tree shops. For many families, this holiday season will not be the same without their local Christmas tree shops. In May, the retailer filed for bankruptcy, closing nearly 70 stores in the process. Then, the chain took out a $45 million loan to revive its business. But creditors terminated it after the company defaulted on the terms due to worsening revenues and liquidity, the Journal reported. Now, the holiday-themed retailer is being liquidated, and by the end of the month, it will have concluded the closure of its remaining 49 stores across 16 states. 2. Rite Aid. According to experts with the Wall Street Journal, Rite Aid is planning to file for bankruptcy this fall. Part of that plan includes shuttering more than 400 locations. In late August, Rite Aid stock crashed more than 50% after the Chapter 11 rumors started to spread. Right now, the company's shares are valued at 63 cents, down more than 90% from their 52-week high of $8.51. Today, its market cap stands at just $35 million, compared to $92 billion of rival CVS. The retailer is in huge trouble with the justice system after being pointed out as one of the companies that enabled the U.S. opioid crisis. The Journal also noted the company is facing over 1,000 federal lawsuits that were consolidated in Ohio regarding the potential bankruptcy. Rite Aid said it doesn't comment on rumors or speculation. In a statement to Yahoo Finance, the company's spokesman said, "We have closed 239 stores since 2021. Like all retail businesses, we regularly review each of our locations to ensure we're meeting the needs of our customers, communities, and the overall business." It looks like another round of store closings is already happening, with locations in Idaho and Ohio closing doors for good this week. Still, that's the least of Rite Aid's problems. If the company is considered guilty, it would not have the means to pay for a settlement and legal fees, which means that it can be liquidated and go out of business entirely. 3. TJ Maxx. The latest earnings report released by the discount chain TJ Maxx shows that sales at the retailer stores are going down. Executives have just readjusted their forecast for annual earnings and same-store sales after quarterly revenue missed estimates again. The company points to red-hot inflation as the main culprit of the downtrend, noting that Americans with lower incomes are slashing spending on clothing and home goods right now. And the two segments account for more than 80% of the discounter's sales. CEO Ernie Herrmann now expects U.S. same-store sales to decline 3%, compared with an earlier outlook of 1% increase, as cash-strapped Americans prioritize spending on groceries and other essentials. Net sales at TJ Maxx's parent company, TJX, dropped to $11.8 billion in the second quarter from $12.08 billion a year earlier, missing analyst expectations of $12.05 billion, according to Refinitiv IBES data. As a result, underperforming stores are being eliminated, and this time around, locations in Minnesota and Connecticut are on the chopping block. Local news outlets reported that this month, a flagship store in St. Paul Medway, Minnesota, and a mall store in Clinton, Connecticut, have ceased operations after serving their communities for decades. Apparently, just like many other major retailers, TJ Maxx is trying to move out of malls as foot traffic continues to decline. 4. Nike. Now even sports retailer Nike is reporting that rampant theft is impacting its profits and forcing it to close stores in 2023. According to local news station KGW-TV, Nike's Oregon and Texas stores are in danger of closing down for good after several cases of brazen theft were reported. At one store in Tyler, Texas, footage shows offenders stealing armloads of Nike merchandise and walking out of the front door with no fear of being stopped. The same is happening in Portland, where closings have already been confirmed. A spike in shoplifting rates has been an ongoing problem for the athletic brand's Portland stores, and an analysis found that Nike's factory store in the city had the second highest rate of reported shoplifting incidents since 2019, just behind Target. The closings are being lamented by local officials as hundreds of jobs will be lost. But for Nike, the decision may help the retailer prevent future losses and face even more difficult challenges in the months ahead. 5. Walmart. Walmart remains the King Kong of retailers, but that doesn't mean it isn't feeling the pressure of a slowing economy. After initially announcing it would shutter 15 underperforming stores this fall, the retailer recently increased that number to 24 stores closing across 14 states and Washington, D.C. Now, some of the states include Arkansas, Georgia, Virginia, and Illinois, according to Business Insider. The mega retailer Walmart cited poor performance at each of the locations. The latest victims were 2 Norwalk, Connecticut stores. A couple of weeks ago, the chain said the locations would stop operating by November. Meanwhile, if you're planning to shop at Walmart at night, you may want to pay attention to the company's new closing times in some locations. Instead of closing stores at 11 p.m., the retailer will start doing so at 9 p.m. to prevent theft and protect workers from potential offenders. 6. Party City. The beloved party goods retailer went bankrupt in January this year, closing dozens of stores in the first quarter. After reorganizing in an attempt to avoid complete liquidation, Party City says it's ready to emerge from its Chapter 11 bankruptcy, proceeding with what it called an optimized store footprint that will require closing multiple locations and getting better deals on leases for others. In its statement, the company said it will move forward with a more profitable store footprint consisting of 800 locations nationwide. As of September 22nd, there are 850 Party City stores across the United States. That means we will have to say goodbye to about 50 of them this year. In fact, it seems that the chain's downsizing has already begun. This week, a Kansas store in Johnson County went dark. More closings will soon be announced as the restructuring plan goes into effect. 7. Best Buy. Once a staple for electronics, Best Buy has had an exceedingly tough year, keeping up with inflationary prices and the higher cost of living. In the first quarter, the electronics retailer announced it would pull the plug on up to 30 of its large format stores in 2023. Not long after that news came out, several outlets reported that Best Buy was laying off hundreds of workers at stores across the country as part of an effort to cut costs and shift to more online sales. In August, Corey Barry, Best Buy CEO, announced that Best Buy would be closing another 17 stores across the country this fall, outpacing their normal annual closure rate for this time of the year of 15. The stores affected are located in Minnesota, Tennessee, Missouri, California, Texas, and Illinois. 8. Foot Locker. So far this year, Foot Locker shares have dropped by more than 30% after the footwear retailer cut its annual earnings forecast, citing softer spending as discretionary categories continue to struggle to rebound. The chain reported $5 million in net losses over the second quarter after sales slipped 9.9% to $1.891 billion from $2.065 billion. Foot Locker's share price fell to $15.41 in August after closing at $23.20 just a day before. Now, the shoe retailer is walking away from malls, and 192 closings are expected before year's end. Retail experts argue that the shutdowns will be another big setback for regional malls, which have been deeply hurting as online shopping has become more popular. 9. Bed Bath & Beyond. Bankrupt since April, the big box home retailer had been trying to restructure its business, but prospects for a revival were looking bleak. In an updated bankruptcy plan, the chain reiterated the bad news to shareholders. It said in an agreement that eliminates particular interests or claims related to Bed Bath & Beyond that those holding these interests will not receive any compensation or benefits. Put simply, shareholders will leave empty-handed. Wedbush analyst Michael Pachter pointed out that the company's debt exceeded its assets even after Overstock paid $21 million for the intellectual property for the Bed Bath & Beyond brand a few months ago. On September the 12th, the company finally confirmed it would liquidate all of its assets and close all of its remaining 360 stores across 40 states. 10. Joanne Fabrics. Mass store shutdowns and layoffs are on the horizon for Joanne Fabrics. This month, the retailer confirmed more store closings for 2023 and staff layoffs at its corporate office. A spokesperson for Joanne, Amanda Hayes, stated that certain positions across various departments are being eliminated to align the company's corporate structure and expenses with its business needs. The exact number of layoffs and store shutdowns has not been disclosed yet. Currently, Joanne operates approximately 850 stores across 49 states. The chain has experienced a significant decline in revenue and profitability over the past year. In 2022, it reported a net loss of $200.6 million, compared to a net income of $56.7 million in 2021. The increase in losses has continued into 2023, with Joanne announcing net losses of $127.5 million during the first two quarters of 2023, compared to $92 million for the same period in the previous year. The results are very concerning, particularly considering that the company has only $19.1 million in cash on hand, while it has over $1 billion in debt. The retailer also saw its quarterly loss rise to $73 million compared to $56.9 million in the previous quarter. On top of all that, the chain is at risk of being delisted, a move that would make it harder to raise needed capital. Today, Joanne shares are down 68% compared to a year ago and off 95% from its peak in 2021. With all that said, it's not hard to see how bleak the chain's reality has become or why the company is now on Moody's bankruptcy watch list. 11. Boston Market. Even after closing 45 locations, Boston Market, the pioneering fast casual rotisserie chicken chain, is worried about the brand's long-term sustainability. CEO Eric Wyatt cited shifting consumer preferences and rising costs for creating a challenging environment. The industry is facing considerable headwinds in the form of increased competition, changing consumer behavior, and rising costs on everything from goods and labor to real estate and utilities. It's not enough to simply keep pace, Wyatt said. We need to actively drive evolution and change. But that may be hard, considering that the company is drowning in debt in 2023. It now owes more than $1 million in unpaid rent, and more than 24 stores have just been shuttered by New Jersey state government after the chain failed to pay their workers. The state's Department of Labor says that Boston Market owes more than $600,000 in back pay to hundreds of workers. The company was also accused by the Labor Department of failing to pay minimum wage and provide sick leave to more than 300 employees. To make things worse, it's now coping with nearly $2.6 million in penalties. In case the chain does not meet its payment obligations, the stores may be seized by the government and closed permanently. 12. Bye Bye Baby. Bed Bath & Beyond owned Bye Bye Baby is now only a shell of its former self. Geared toward products for infants and young children, the company was shareholders' last hope of turning out a profit after the bankruptcy of its parent company. Unfortunately, Bed Bath's crown jewel did not receive the hefty bids that some had expected or had hoped for. The Journal reports that Dream on Me bought Bye Bye Baby's intellectual property assets for a mere $15.5 million. Now, Bed Bath & Beyond is trying to keep the Bye Bye Baby chain open through a sale to retail investment firm Go Global Retail. Still, more than 100 locations will have to close doors, given that the potential buyer aims to continue operating the brand exclusively online. 13. Journeys. Footwear and accessories retailer Journeys previously announced that it would close 60 stores this year. However, according to parent company Genesco, that number rose to 100 as the brand seeks to cut costs. Consumer demand at Journeys dropped off significantly early in the quarter and did not improve as we changed seasons, Genesco CEO Mimi Vaughn revealed. In response, we're taking swift actions to mitigate the consumer shift in the marketplace, including closing more underperforming Journeys stores, reducing our cost base further, and working to quickly refine our product assortment, Vaughn added. In the last quarter, Genesco's net sales dipped 7%, driven by a decrease of 13% at Journeys. By closing an additional 40 stores, the company expects to save up to $40 million, higher than the $20 million to $25 million it previously estimated. 14. Shoe City. This fall, Shoe City is saying its final goodbye to American shoppers. In April, the footwear retailer filed for bankruptcy after a deal with Achilles Group, the parent company of the athlete's foot, failed and suppliers started refusing to provide high-end products and new sneaker releases to the retailer because of its low sales volumes. Unfortunately, after 74 years in business, the Shoe City legacy has come to an end, Chief Restructuring Officer Stanley W. Mastill said. Right now, Shoe City is in the process of shuttering its last 9 stores after 40 closings were announced in May. 15. Tuesday Morning. Tuesday Morning has filed for bankruptcy twice in the past 3 years. Now that we're in the final months of 2023, the chain is going out of business entirely. At the beginning of the year, there were still 487 Tuesday Morning stores across 40 states, down from over 700 in 2020. Now there are only 143 stores still open, but not for much longer. The remaining locations are liquidating inventory right now, so you can still check out their deals. However, Tuesday Morning aims to solely operate as an online business in 2024, disappearing completely from the U.S. brick-and-mortar retail scene. Unfortunately, those store closings aren't the only losses Americans are dealing with right now. Hundreds of thousands of retail workers are being laid off while these companies fight for their place in the market or quit it entirely. The impact on our major economic indicators, including the nation's gross domestic product, will be significant, but for countless hard-working Americans, the retail crisis will completely turn their lives upside down. Thank you for watching.